Welcome back. This is Ask the Compound. Our email here, askthecompoundshow@gmail.com. Today's show, we're stacked. Very diversified set of questions. We're talking about questions about gold today, how many stocks you need to be diversified, tax ramifications of moving from a low tax to a high tax state, which is why I'm never leaving Michigan. We got pretty good taxes here.
One question that kind of sounds like it's from me.
Oh, could be. Yeah, well, you'd be the opposite. How to maximize retirement contributions when you have freelance income, and then how to utilize investment tax credits. Let's go. Today's show is sponsored by something new, the Compound newsletter. So we produce a lot of content here. It's kind of hard to keep up sometimes. We do have a lot of people in the chat who try to follow a lot of our stuff. It's hard for a lot of people. So the Compound Insider, link in YouTube. It's also, you can go to thecompoundnews.com/subscribe to subscribe for more. Basically, you're going to get a weekly wrap-up of all our content, videos, and podcasts, and blog posts. There's going to be announcements there. You also find out who the Friday guest is for the Compound and Friends.
Right, yeah, you find out the week before who our next TCAP guest is. So it's the only place that we're releasing that.
And Nicole tells me we're going to be picking one lucky subscriber to the newsletter before next week's show to win free Compound merch, which is good. My daughter asked me this week, is it still idon'tshop.com?
It is.
Does that still work?
That is ours. Forever.
Right. Good deal. So subscribe to the newsletter. It's helpful. All right. Let's get into it. First question.
Okay, up first today, we have a question from John. I don't recall any questions being asked on the benefits of gold investing. Gold has increased by around 7% a year for the past 10 years, but it's never mentioned by any of the compound shows as a good investment. Is it not better than holding cash since cash purchasing power will go down as inflation goes up, whereas gold will at least keep up? And yeah, we got a nice gold member reference there. Right.
So I'm not surprised we're seeing some more questions about gold because it hit a new all-time high this week, a little over $2,100 an ounce. Good time. People are going to be paying more attention to the yellow metal. So John in the question said gold is up 7% per year. Something I have to myth bust him here, John. Give me a chart on. I'm showing returns for gold of around 4.3% for the past 10 years. So not quite that high. Not bad, though. So not quite as high as you think. So gold is seen as this diversifier. So I think even though it hasn't really kept pace with the stock market the last decade, which I think the U.S. stock market is up 12.5% over the last 10 years through yesterday, I think it'd be helpful to look at long-term returns. So luckily, Aswat the Motor at NYU pulls these annual return charts for all the big asset classes, stocks, bonds, cash, real estate, and this year he added gold. So I looked at back, and this is going to 1928 to 1923, annual returns for stocks, bonds, cash, and gold. So we're talking S&P 500 through in T-bills, 10-year treasuries, and then gold. So stocks are up close to 10% per year in that time. Bonds, it's 4.6%. Cash is 3.3%. Gold, 4.9%. And the people who want to adjust everything for inflation, because I know everyone asks these days, inflation was like 3.2% over that period. So take that off if you want to look at real returns. So gold has done a little better than bonds, better than cash, but trailed the stock market by a decent clip. But. A lot of context required here. The price of gold was essentially set by the government until Nixon took us off the gold standard in 1971. So you couldn't convert dollars into a set amount fixed rate of gold anymore. So from 1928 to 1970, gold was up 1.4% per year, which was less than the 2% inflation rate. Because again, the government essentially controlled the price of gold. They didn't allow it to freely float. Then 1971 to 1923, once gold could freely float again, it's up 7.9% per year. So that's much better, right? S&P was 10.8%, but that's a lot closer than it was for the really, really long term. But the big thing here for a lot of people why they like gold, the correlation of annual returns in that point was negative 0.2. So you're getting some solid diversification benefits there. However, these post-1970 returns also require some context. Those returns are very front-loaded in the 70s. From 1971 to 1979, go high, Duncan. What was the annual return in gold for that 9-year period? Go really high.
21.
34% per year. So gold was up like 1,300% or something from 1971 to 1979. And some people say, well, that's because it's a great inflation hedge, right? Well, part of it could be that, but it was also because it was playing catch up from 4 or 5 decades of not being allowed to freely float. So I think it's hard to say that those 70s returns are normal. Now, if we look at the returns since 1980, continue their context here, it's a different story. From 1980 to 2023, gold was up 3.2% per year. That lagged stocks badly, that lagged bonds badly, that even lagged cash. The inflation rate over that time was also 3.2%, meaning gold essentially went nowhere. John, give me a chart on here. This is gold versus the CPI since 1980. Gold is slightly, this is through yesterday. Gold is slightly trailing CPI since 1980. So for a very long time, 40 plus years, gold has essentially lost out to inflation. That's a tough look for a supposed inflation hedge, right? But even in that period where gold has had a long stretch of not doing very well, there's still been some diversification benefits. So lost decade of the aughts, which still, I don't really get where that came from. 2000, 2009 is called the aughts. Is there a reason for this?
I know when you're talking shotguns, aught is used to mean zero, but yeah,
Okay.
I don't know.
Also, I haven't heard people call this the 20s yet. When are we going to start calling it the 20s?
The Roaring 20s. Right?
Well, so during that decade, the S&P lost 1% per year. It was on 10% on a total return basis or so from that 2000 2009 period because you had bookended 50% crashes. But in that same decade, gold rose more than 14% per year. And in fact, if you start in the year 2000, so end of 1999 through 2023, gold has a better return than the S&P 500. 8.5% per year for gold, 7% per year for the S&P. Now, to be fair, that's an all-time bad starting point for the U.S. stock market. At the dot-com bubble, it was the highest valuations in history. But you could say the same thing about gold from 1980. That's got to be the worst starting point ever because returns were so high in the 70s. So if we look at the post-Great Financial Crisis period, gold is up 6% per year. We're talking 14% per year for the S&P almost. So I've done a lot of back and forth here. So where does that leave us? As with most asset classes, you could pick a start and end date that makes your asset class look good, and gold is no different there. Gold is probably one of the ones that you can start the most fights about if you wanted to, for this is good, this is bad, pros and cons. But there are diversification benefits. John, throw up the chart of decade by decade returns since the 70s. And you can see a lot of time in the 70s, again, gold did amazing. 60s or 80s, not so great. 90s, not so great. 2000s, awesome. 2010s, not so great again. 2020s, it's been okay, actually. So I think diversification is gold's biggest selling point. It really does march to the beat of its own drum. I personally have nothing against gold. John said we don't really talk about it much. I think it's not right for me personally for my risk tolerance and allocation preferences, but I understand why certain people have an allocation to gold. It's just the kind of asset class where you have to set an allocation and rebalance into the pain and being willing to look bad against the stock market or the bond market for a while. I think it's also interesting to think about gold through the lens of millennial/Gen Z gold, which is Bitcoin, because the flows into Bitcoin ETFs these past few months have been insane and very impressive. And even with gold at new all-time highs, the AUM for the biggest gold ETF, GLD, has actually been falling. So John, throw up a chart here. Assets under management for GLD were like 80 billion in early 2020 and have actually fallen by a third since then. This is the same thing for the second biggest ETF as well, IAU. So the fact that money hasn't been flowing into gold ETFs hand over fist while it's at an all-time high, I think is interesting. Gold is obviously far less volatile than Bitcoin, so I think there's a place for both to exist. But I do think it'll be interesting to see if there is demand for Bitcoin that dampens the demand for gold. Now, gold has thousands of years on crypto. Like, one of the reasons gold works as a store of value is because for thousands of years, people have decided it's a store of value. So I wouldn't be making that bet yet that gold is going to just go away because crypto's here. But technology can change things in a hurry. So that's kind of where I fall on gold. Like, I understand it's a diversifier. I understand why people invest in it. I don't personally, but that's just because I don't think I have to necessarily invest in everything that can be a diversifier.
And I see a lot of people talking about holding physical gold. I mean, that's very different. You're talking about like buying an ETF, but
Yes.
what's the rationale there to own the physical gold yourself?
So you can brag about it to your friends, I guess. I really don't know. I don't.
Okay.
I
You can melt it down and make something one day if you want to.
I don't see putting up with having a safe and if someone takes it, it's gone.
Right.
No one's going to come steal the gold that's underlying the ETF. I don't think, unless Mark Wahlberg does it in a movie. It's I don't see that happening. So yeah, I think ETF makes.
And
more
is there
sense.
any reason? What I've always wondered is there's a bunch of different gold ETFs. Why wouldn't you just buy the lowest cost one? Is
Well,
there
a lot of
any
it is
distinction?
No, it's gold is gold.
Maybe
it's,
like
it's
where it's held.
Well,
like
think about
which...
when you go to the CVS pharmacy. Do you buy the name brand medicine or the off brand? Right. I personally, I'm willing to buy the off brand because I think it's going to be okay. I think the government is looking out for our health, but some people would rather buy the name brand Tylenol as opposed to, you know, the one right next to it that is a little cheaper.
You're a very trusting person. That's why people love you.
I'm trusting the FDA. Sorry.
Good luck.
All right. Next one.
Yeah, I guess I trust generics too. Yeah. So yeah. All right. Up next, we have a question from Zach. I'm in my early 30s and enjoy actively managing my money. This is the one I said felt like it could be for me. Researching companies, markets, macroeconomics, etc. I have retirement accounts with index and target date funds, but I also have a brokerage account for fun. People adamantly advise against stock picking and say to use index funds instead. However, at the same time, others say that as a stock picker, there's a theory of diversification in picking too many stocks. I often get caught up in my research and find myself buying loads of small positions so nothing exceeds 5% of my portfolio. Where do you feel the sweet spot is between 100% Oatly stock and recreating the S&P 500? I love that I'm like becoming the roaring kitty of Oatly or something, you know?
That is true. The only thing I have to say is I like the stock.
Yeah, exactly.
What did I say to you? Was it last week? You said, listen, trend following stinks because I buy a stock that goes up and then it immediately goes down.
Right.
And all I said
work.
was just come to the bright side of index funds all the time and don't worry about it. And you said, I'll get to that point eventually, but I'm not there yet, which I can appreciate. Michael and I talked about this sort of barbell approach on Animal Spirits this week where you have relatively boring strategies in your retirement accounts, in your IRAs and 401ks or whatever, index funds, target date funds, whatever, pretty simple. And then in your brokerage account, you have some fun, picking stocks, buying crypto, trading options, Oatly call, whatever. And I get that. I'm a proponent of the fun account, assuming it's sized correctly. Now, here's my thinking on the matter. If you already own index funds and target date funds, what's the point of diversifying your stock picks? Like, this is where you should have some concentration because, again, it's a fun thing. That's fine. Invest in penny stocks or beaten down 52-week lows or 52-week highs, whatever it is. But if you're actually trying to outperform the market, you need to be different than the market. Of course, the trade-off with a concentrated portfolio is it can offer you the better ability to outperform, but also more risk of underperforming. I think at this point I've read every single Buffett book that there is, probably every good one at least, and I think my favorite ones are by Robert Hagstrom, who is a portfolio manager himself, and he wrote The Warren Buffett Way, The Essential Buffett, and this one is probably my favorite, The Warren Buffett Portfolio. And essentially it's like case studies and investment theories surrounding Buffett's concentrated style of stock picking. And in the book, Hagstrom performed this study, and this is written in like the 90s, so it's a little dated, but the meat of it still makes sense. So he looked at 12,000 randomly generated portfolios from a universe of 1,200 stocks, and he broke them down into holdings. So he did 3,000 portfolio Monte Carlo simulations with 250 stocks, then 100 stocks, then 50 stocks, and 15 stocks. And then he looked at 18 years of performance from 1979 to 1996. The returns are high because that was the 80s and early 90s, so it was like 15% per year for the stock market. But then he figured out what's the best return and the worst return by number of stocks. So John, give me a chart on here. So this shows with 15 stocks, you can see you can drive a bus through it. The best return was like 27% per year. The worst was 4.4. Then you go up to 50 stocks and it's 19% for the best, 9 for the worst. At 100 stocks, it's 18% for the best, 10 for the worst. And then you go up to 250 stocks and it's 16% for the best and 11% for the worst. So the range is shrinking the more stocks you own because you're getting more index-like. So the concentrated portfolio is a double-edged sword, but what's the point of picking stocks in a manner that looks mostly like the index if you're already invested in index funds? Why pick stocks at all if that's the case? You know, you could still have fun picking stocks, but I think I like the idea of a more concentrated portfolio as opposed to owning like 30 individual stocks in your brokerage account because you're worried about one of them taking too big of a piece. I thought that's the point of it if you already own index funds. So that's kind of where I fall on this.
Yeah, that's kind of how I've treated it. And to me, it makes sense, foreshadowing of our guest today, but to me, it makes sense to take those risks in a brokerage account where you at least have tax loss harvesting, available to you instead of, I don't want to have a bunch of like zeros in my IRA,
Yeah.
So that's just me personally.
Yeah. I'm not a bad stock picker. I'm just harvesting losses here.
Right.
That's
exactly.
all.
Yeah. Yeah.
I know how to pick stocks. I choose to pick the losers so I can harvest losses to offset my gains.
It actually takes more talent than people realize. Yeah.
I still hold probably 5 to 6 individual stocks in my brokerage account, and I've been slowly but surely transitioning that into all index funds in there. It's going to take some time, but that's where I've fallen on this.
And to take us back to the first question for a second, Warren Buffett famously said something about how he doesn't invest in gold because it doesn't pay a dividend or something, right? Is that
Well,
correct?
he said you could take all the gold in the world and it would fit inside an Olympic-sized swimming pool or something. Like he doesn't see the point of it. I wouldn't go that far. Actually, I get the reason that certain people invest in gold. I don't like the people who look at it like a religious zealot and think like you have to have all your money in gold because the government's going to come confiscate it from you. That's
Right.
the kind of thing. If you want to have 10% of my portfolio is in gold because it's a diversifier and I'm going to rebalance and that sort of thing, that makes sense to me.
I'll wait until a huge market crash happens and then I'll buy it and then immediately get cut in half when the market turns around. So that's what I usually do.
Good strategy. All right, next question.
All right. Up next, we have a question from Matt. Question for Bill. My wife and I are moving to a high tax state when the Tax Cuts and Jobs Act expires.
Nailed
Expecting, yeah, that's right. Expecting a significant income increase, which will place our capital gains bracket at 15% federal plus 3.8% NIIT. No idea what that means. Plus 9.
It's a college basketball tournament.
I was thinking NIT. Plus 9.3% state tax. Not to brag, but unrealized capital gains will be realized to buy a house. Do you ever
That almost isn't a brag these days because houses are so expensive.
Right, exactly. Do you ever recommend front-loading capital gains in this situation? For example, we could realize gains to fill up the 15% bracket before NIIT, holding on to tax losses until after we move to help with the jump in state tax. Fellow Army guy here. Oh, thanks for your service. And when you say that, you're going to get billed.
That's true. Well, each week I get a new Google Doc with questions, and I think we're breaking out to new highs on the number of questions. So if we don't get your question, we apologize. We
Right.
get a lot of
One
them.
day.
Not to brag. But this week alone, we had 3 questions that were directed directly at Mr. Bill Sweet. So why don't we bring him on since they're asking for him by
I'm
name?
back.
Hey, Bill.
Bill,
Guys,
what does
I was
what does
taking
11A
notes.
mean?
Yeah, 11A. That's an infantry officer, and I was a tank officer. So my job was to take out the heavies, and Matt was there to take the high ground and take the objective.
Wait, so were you sticking out the top of the tank, like pointing? Is that, like, what
Basically,
you were doing?
yes. Goggles, binoculars were involved, yeah, and then a 120 millimeter main gun. But the Army fights in combined arms, so ultimately we kind of all mix it up on the battlefield, and I wouldn't have survived my year of combat without Matt on the ground. So thanks, Matt. Appreciate
Nice.
it.
All right, good deal. All right, before we get into this question, best and worst states for tax purposes. Obviously, California and New York are the worst.
Oh yeah.
They have to be right up there. Michigan is probably top quartile for best. Is that fair?
Yeah, Minnesota too. Shockingly high marginal tax rates, I would agree. Yeah. But Matt's almost certainly going to California. 9.3 state tax. That smells like the West Coast to me, the left coast, if you will.
Explain to us the NIIT tax.
So that is a bracket. It's an alternative college basketball. No, it's a net investment income tax that is taxed on folks making above $250,000 joint. So again, not to brag, good on you, Matt.
So is there an
Service paid off.
arbitrage play here? He's in a low tax state now, moving to a high tax. Should he pull forward a bunch of taxable stuff, or does that not really make sense?
Yeah, this is a great question, and we get it a lot, Ben, Duncan, as you know, here at Ritholtz Wealth Management. I'm a company man. And in order to answer it, I think we should put together a quick model and just think through it. The quick and dirty answer is no. In most cases, and this one too, it makes sense to defer. So John, can we chart this piece on? So I put a quick model together for folks listening at home. Just bear with me because it's a little bit complicated. But what Matt described is Duncan nailed it. After the Tax Cuts and Jobs Act expires sometime in 2026, Matt expects his tax rate to jump up from roughly 15% to 28% all in. And Ben, as you said, Matt's question is, should I realize some gains now? My tax rate is 13% lower. The answer comes in deferral. And what I've done here in the chart in the middle ground, I want to kind of point out to the viewer at home, is that we take a look at scenarios of deferral. And so option A, scenario A is Matt just holds on to his gains. His gains compound at 8% just as a model rate, right? Not a real rate of return, but let's just say that happens. Matt's going to turn $100,000 and $136,000 in 5 years. So let's move over to plan B. Plan B, Ben, would be if Matt decides, hey, I'm going to realize some of these capital gains now. I'm going to realize, roughly a third of my capital gains per year over the next couple of years once we get started. And you can see the difference. What Matt is going to do if he realizes gains early is turn $97,000 after taxes to $91,000 after taxes. Ben, any ideas why that might be the case?
So he's getting rid of the compounding effects.
That's it. And so ultimately, that's the big problem that Matt would introduce, is that if you're pulling assets out of the market, if you're paying taxes, if you're sitting on that in cash, put it in T-bills, some risk-free rate of return, that's no longer at risk. You're no longer compounding. And the key point, Ben, here is you're no longer enjoying the benefits of tax deferral. That's the key. And so can we go back to the chart for 1 second, John? So in scenario, see what I did is I said, look, let's say Matt just invests the money that he's pulling out of the market and just rolls it right back in, right? Realizes the gain. He still ends up underwater relative to his scenario by about $3,000, so 3% of his original value. And the reason is the tax that he's paying along the way, those assets are no longer compounding for that 5-year example period. So that's the scenario. That's what I think I would like to avoid. And so I think the answer is, even if you're looking at a higher tax rate in the future, deferral is still the game that you should play.
Okay, let me give him a benefit of the doubt here and say he knows he's going to buy a house in 2 years. Mm-hmm. Then does it make sense? So he's not going to be putting the money into the market. So because he said he's going to realize some capital gains to buy a house. So because I'm a big proponent of, if you have a big purchase coming, you do not risk that in the market. So if he knows this, I need to put it in cash or whatever. Does that make sense then, potentially?
Yeah, you're exactly right. I think in a 2-year scenario, that would make a little more sense to me, because we're not dealing with longer time periods. Assets aren't compounding as long. So yeah, I think so. But my general thesis here, Ben, is that time in the market is always going to be trying to time the market. And so I would just always sort of choose the deferral, the advantage there. Maybe you can take a loan. Maybe there's other options, especially if you don't have any certainty. Why pay taxes now if you can defer until later?
Right. And you don't know what they're going to be in the future anyway.
Correct.
Okay.
Great question, Matt. We get it a lot. And again, thanks for your service. Thanks for keeping me safe out there.
Next one.
Okay, up next we have a question from Eric. I earned about $25,000 in freelance income in 2023 on top of W-2 income. I want to invest the entire amount, but I'm confused about my options. Is 1099 income counted towards income limits for Roth contributions? I'm already over the income limit due to W-2 income. Should I open up an individual 401k to lower the tax burden for 2023? I have money in a pre-tax traditional IRA from a former 401k. Can I roll this over into this money into the solo 401k, even though it's W-2 money? And can I then do a backdoor Roth? Is there anything else to consider?
All right, a lot going on
These are
here.
getting real technical.
Yeah, that was really complicated. Yeah.
Freelancers and small business owners actually can contribute way more than salaried employees.
Yeah.
But they have to know what they're doing. So
I gotta say, I didn't even know an individual could start a 401k. I thought it was only company sponsored. Learn something new.
Yeah, even big companies start out as small companies, Duncan. So
yeah. Vanguard, Charles Schwab, and any of those. So let's use me as an example. I have some freelance income from writing books or blogs or podcasts or whatever. I'm technically my own, a Wealth of Common Sense LLC, I think is the name of my individual business. It's just me. And so I have the ability through a individual 401k or SEP IRA or whatever to contribute way more than I could from a 401k. I do that because my tax man, Bill Sweet, told me to.
Yeah, and I would recommend that Eric consider the same. So he's got a lot going on, Duncan. I think you hit the key here. So he's asking about Roth IRA limits. It sounds like he's trying to determine whether he can do a Roth with his Roth IRA. The answer is no. There's an income limit relating to Roth IRAs. And so if you're exceeding that with W-2 income, question one is the answer is no. So we can skip right over that, because I'm guessing his income is above $150,000 a year. Not to brag, that's a great problem to have. However, that opens up the door, Ben, exactly like you said, that he can contribute and open up his own business retirement plan. And the solo 401k can now be open in arrears. And so if this is 2023 income, we're sitting right now this month to work on our 2023 income tax. He's got a window where he can save any amount that he didn't do in his 401k. He can plug that into his own solo 401k. The limit for last year was $22,500. And so depending on where the limits are, he can contribute up to that amount, $25,000 of income. Sounds like a nice fit. Plus, Ben, exactly your point, a profit sharing element too. And that's going to, for Eric, run about an extra $4,800. So I would recommend it. And the big thing for Eric, the big benefit he would have, if he's funding these contributions today, he can take a tax deduction relating to last year. And the deadline would be up to the tax filing deadline plus extension. So you could potentially extend that all the way out to September, meaning that he can earn some money on his capital, he can sort of invest it for the future, and still take a tax deduction in arrears for 2023. It's a pretty good deal.
Right, so he can essentially have like dueling retirement accounts going at once.
Yeah. And so back to my prior point, time in the market tends to matter a little bit more. And so there's a tax advantage there. However, this is the type of thing, Ben, that I would sit down with a tax professional and plan out, because there's a lot of moving parts here, right? You need to open up a 401k. But Eric gets to the backdoor Roth question. And absolutely, if he has a bunch of assets in an IRA, He opens up his own retirement 401k. A solo 401k is still not an IRA. And so he'd be able then to participate in the backdoor Roth process, but only for 2024, not in arrears.
Right. So we could do 401k, solo 401k, backdoor Roth, all three of them.
Yep, Eric opens up a lot of cool things that you can do with that revenue and income, and saving for retirement is a
lot of tax deferral.
Yes, amen. So I would go full bore. The only caveat Eric asked at the end, what am I not thinking about? Assets you're putting in here, you really can't top that until 59.5. I would wait. So again, talk to a financial planner before you make any decisions.
Yes, and as I bump up on the maximums of some of my retirement plans, it would be nice to look for other ways to do that, but I also think I should be filling up the taxable stuff now too, because I want that flexibility if I'm going to spend the money earlier. And the retirement stuff I know is decades into the future, and I'm not going to be able to touch it.
Exactly. Yeah. New for 2024. The reason I didn't lead with this is companies don't really have the answers to this yet. It's relatively new, but there's the opportunity to do a Roth SEP, which is, to me, the best of both worlds, because ultimately, if Eric's tax rate is relatively low, it sounds like it's not. Assuming it is, he can fund a Roth on a retirement plan and just get all these dollars in on a tax-deferred, tax-free basis.
So that's a new one. You didn't used to have the Roth option there?
Correct, yeah. And the sponsors that we work with, unfortunately, still haven't solved that. So that was new for 2024. This is the first year, and they still haven't rolled out the solutions. As far as I'm aware, Fidelity, Schwab, Vanguard.
No one has one?
Yeah, nobody has one quite yet. So we're still waiting for that. And again, maybe that's a reason to extend and tackle this problem later in the year, Mr. Eric.
I'm actually surprised that the government allows you to continue to do those, 3.5 months of contributions for the prior year.
Yeah, it's a lot.
I'm surprised they don't cut it off at the end of the year.
Yeah, and I guess old rules, they used to have the ability, you had to have the plan set up in December of the prior year in order to fund it in the current year or declare, but the Secure Act changed all that, made it a little bit easier to do. I guess, Ben, accounting takes time, and it's really, really, really hard for us and everyone else to find good tax people. So I think it's not a terrible idea to buy a little bit of time.
In February, I made a contribution for my last year's SEP IRA.
Yep.
Yesterday, I not to brag, I put some money in my Roth IRA for 2023.
Wow, great.
Yeah,
So
it's like time travel.
We eat our own cooking, guys, here on the show. I love it. Great job, man.
One more question.
Okay, last but not least, we have a question from Jeff. I've received 2 different emails in the past weeks from a firm that specializes in tax liability reduction using investment tax credits. Upon receiving the second email, I wondered to myself, what would Bill Sweet say about this? Is this worth investigating to reduce tax liability? I've never heard of this. I have no idea. I'm about to learn something new.
We need to make bracelets. What would Bill Sweet say about this?
Yeah, right.
I'm usually skeptical if I get an email sales pitch, and I always tell my wife, whatever you do not click on any links in any emails, right? That's
good advice.
Click here to change. Just never click on it. Type in the address yourself. Don't click on the links, right? I'm sure people have parents that have done this before.
Yeah,
I just
cybersecurity
gave my
corner with Ben.
Yeah, I gave my social security and bank account information to this website. Does that make sense? Okay, explain to us what investment tax credits are, please.
Yeah, so relatively complicated. This is not for the entry level or even median sophisticated investor. But the concept here, guys, is you do a deal with a syndicate, a partnership, and what they're offering for sale are these tax credits for certain types of investments. The most prevalent of which, due to the Inflation Reduction Act of 2022, there's a lot of solar and energy and kind of clean energy credits that are available. And the idea is you can just do this directly as an individual, right? You don't need a syndicate to do it. However, at certain times during certain specific situations, it does make sense to compile, right, and do this through a professional. So the idea is they form LLCs, they form partnerships, they put a solar farm together or something of that nature. And for each dollar that you end up investing, you get back $1, $1.05, $1.10, $1.20 in credits, depending on the project, that you can potentially use to offset other income. It is an extremely complicated road to hoe. This is not something I think, again, is for the unsophisticated investor. But the idea is subject to holding periods as long as 5 years. You can potentially go out and basically get some tax credits up front to help reduce the total cost of a project and change the world while you're doing it. So pros and cons. I think
this is a CPA type thing.
Yeah, this is relatively, and it's private placements too. So there's no vanguard of investment tax credit investing. I tend to think that, look, for very sophisticated investors, maybe. However, there's a bunch of hurdles that need to be hit because there's a lot of downside with this type of thing. Number one is a holding period. Number two is your tax return has to kind of, be able to eat these things. Like if you invest in a certain type of energy credit and it doesn't make an impact on your tax return because you don't have any taxable income, There's no point in doing it. Like there's no benefit. But really the big problem is private placements, not diversified, and furthermore, a lot of legislative risk. So if you need a 5-year holding period, and let's say the law changes, let's say we have a change in administration, change in tax code, guess what? Your tax credits just evaporate.
And you always say, like, don't let the tax tail wag the investment portfolio dog. You don't want to make an investment just because of the tax ramifications. We had a call with a client this morning who was pitched a new investment idea, and the whole idea of the investing platform was tax savings. And the point is, great, you could save some taxes, but what if your performance is terrible? Is it really worth it?
Hey, I've got a great way to save on taxes, and it's to lose money, right? That's a really easy thing to do.
That's what I'm saying.
You always say, like, if you're paying taxes, that means you've won the game.
That means you won the game, exactly.
It's not fun, but it's better than the alternative.
Yeah, so I would say very, very generally, if you're getting a pitch for an investment product, that is skeptical, number one. Like it's the advice, the investment advice equivalent of don't click on the link, right?
Yes.
I think good investments sell themselves. One of Ben Carlson's big contributions to our investment committee is simple beats complex. It only needs to be as complex as it can. There's a lot of opportunities for tax loss harvesting. We use direct indexing portfolio, municipal bonds. There's a lot of investing is a problem that has been solved. And these types of private placements, in my opinion, are usually not worth the salt. Every once in a while, the case might be there, but I think in very general purpose, I would say the answer is no.
So some
That's a
people
stereotype. Oh, sorry. I was just going to say that's a stereotype about millennials I think is 100% accurate. Like, we don't want to go to the door when the doorbell rings. We don't want to answer our phone ever. And if anyone ever contacts me trying to sell me something, I immediately assume it's a scam. I won't. I will just hang up. I have no interest. Not even a thing I would ever consider.
Not going to answer your phone. Exactly. You have to actually talk to someone on the phone about it? No way.
Is that why it took me a week to get you on the line last week?
Exactly.
But I mean, you guys opened the show talking about gold, Duncan literally said the roaring 20s and then wished for a market crash. My question to you two gentlemen, are you trying to ruin the fun for American investors? Like, what are you doing here?
Healthy
exactly?
correction, Bill. That's what it's called. Healthy.
Yeah, I do
Also,
like the Charlie Munger quote. That's when stocks return to the rightful investors, right, during a drawdown.
That's right.
There you go.
Some of the people in the chat saying that a lot of them had to turn off email for their elderly parents because they didn't want them to get taken advantage of. That's kind of like Creed in the Office.
It's 90%.
Remember when Duncan? Remember on The Office when they created a blog for Creed, but it was just a Word doc. That's kind of what you have to. I can see
love
that.
Yeah.
So follow me after this call. We'll throw our phones out the 15th floor window into Bryant
Yes.
Park down below.
That was
All
good,
right.
yeah.
Thank
Also,
you to Bill
talking
as
about
always.
March Madness is on my mind. You mentioned the NIT.
Yeah.
We should do a bracket on the show. We should have some brackets.
A
going.
bracket of Ask the Compound guests. Guess who's at the top of the food chain?
I meant of actual.
Bill's a one seed. All right. As always, thank you for Bill for the help. I should schedule right now because I'm still 5 weeks away from tax time. I have to do my taxes still.
Let's do it live. Let's do it on the
All
show.
Oh, there's an idea.
No thanks. Thank you to Duncan and his beautiful hat collection as always. askthecompoundshow@gmail.com. Remember, check the link here for the Compound newsletter. Leave us a question. Leave us a comment on YouTube. And we'll see you next time.
Thanks, everyone.